While the likes of Japan is in a deflationary environment, just looking at the PPI numbers that came out yesterday, rising by 2.9% month on month, and this really shocking the markets because we were expecting a contraction of about 4 to 4.5%.
Well, the 4 to 4.5 was really on the year-on-year figure, which turned out to be just over 3% down, still year-on-year.
3.8%, yeah.
So effectively, we're still at PPI level in South Africa. We do have deflation, and it's very much driven by lower commodity prices and also by the strong rand. But those things haven't spilled through into the CPI yet.
Just looking at our CPI number coming in at 6.7% in July, and considering we had a disappointing PPI number, how is that going to impact CPI going forward?
I don't think that CPI going forward is going to be very much affected by the PPI figure because both of those figures have now seen the electricity rise in it. So effectively the downward trend is in place, but with a break of the electricity rise. And what that just shows you is that if you have unsustainable policies, you'll have to rectify them at the most inopportune times.
Okay, well, how's this going to impact an MPC decision? There's two camps. Some say that we'll definitely see one more rate decrease, and others say that rates are going to remain unchanged.
I think that the MPC on the whole will feel that rates are roughly appropriate because with a lag, banks should start lending again. But what happens at the moment is that rates are a lot lower than they were, but banks are not lending because property prices are still falling. And banks don't lend into lower property prices. So we need the property market to stabilize or turn around for banks to really start lending aggressively again. And we probably won't see that until sometime next year.
I mentioned Japan earlier, CPI falling 2.2% in July. Just looking at the likes of Japan, we also have the jobless rate there rising, no surprise there, but GDP swinging back into positive territory.
Very small positives, but positive at least, but very much on the back of exports. And that's why the Japanese market also reacts positively to US data rather than to Japanese data, because the market in Japan has become used to not really being led by what happens in Japan, but mostly being led by what happens in the US.
And you mentioned most of the gains, or GDP in Japan currently at 0.9% for the second quarter. But are these exports-driven economies going to sustain the growth? I think that's one of the big questions right now when you're seeing China easing off some of the credit that they've been giving out. And also the restocking process has also taken a bit of a backlog.
I think that we're going to see worldwide growth resuming in the third quarter. We've probably seen the bottom of the cycle globally in the second quarter of this year. So I think that the multiplier forces in the world economy is going to be quite strong. But if you're looking at the export-driven economies, you need to look at the consumer or investment-driven economies to see whether they will still be growing. And we have every reason to think that China will still be growing very strongly. India is also growing very strongly. So quite a commodity-intensive swing back to growth in the third world, if you like.
Second quarter reading for GDP in the US coming in showing contraction of 1%, and this really assisting the likes of the oil majors on the back of higher oil prices. Again, do you think that a number like this is sustainable? And we've had a lot of good news out of the US this week regarding economic data.
I think it is sustainable because what we are seeing is we're seeing housing sales going up, which is the precursor to housing prices rising, which is the precursor to credit starting to flow through the economy again. So very good news out of the US economy. Also a lot of car sales. So the whole clunkers, cash for clunkers strategy working very well for the US. So government intervention to strengthen the economy is working really well. What is a bit worrying from a market point of view is that the market didn't react in a very positive way to this growth, meaning they actually expected a little bit more, or they weren't surprised on the upside, which means that the market is probably overstretched for the kind of recovery we see.
It's quite interesting that you said that because we're seeing rallies throughout the globe, especially here in South Africa as well. Do you think that the markets are due for a correction? As you said, most of the good news has been priced in. Perhaps they were even expecting more.
If markets are very sensitive things, and if you see markets not reacting the way they should be, it probably means that they want to go the other way. So there's probably a little bit of a weakening needed in the markets. But in the markets, what we're seeing now is the old adage, if you're down 50% and up 50%, you're not back where you started. So we're still way down from where we started, but we're 50% up from where we were in March.
Well, apart from it being all about the house prices, it's also about the consumer right now. And just taking a look at the retailers releasing results here in South Africa over the last week or so, looking pretty good for the likes of Shoprite, the likes of Woolies. Massmart didn't fare so well, but let's compare a company like Woolworths, which is not really based in Africa, with the likes of Shoprite that has a massive footprint and getting the Africa story right.
I think that the Shoprite story is one of the phenomenons of the South African stock market, if you like, because in a terrible time for the consumer, they just keep growing, and a large part of that is driven by their African expansion. Woolies, interestingly enough, also being helped by their offshore operations rather than by their local operations. But you have to say that the current circumstances fits Shoprite like an absolute glove. It also says, the USave stores, which they started 3 years ago, timing absolutely spot on, which is just kind of one step down. So everybody's trading one step down, and if you're in that market, it really helps you strongly. Whereas Woolworths really is in the upper end of the market, so you should expect this kind of cycle to really hurt them.
One of the other things that we've seen emerge is the rand affecting a lot of the companies, the likes of MTN, the likes of Massmart. Of course, we know the impact that it has on resource companies. Liberty, one of the big ones, taking a knock from hedge against currency losses. What do you make of all of this? Because the rand has strengthened and no one really expected it to strengthen to this extent.
I think that being too negative about South Africa has often been to the detriment of companies. If you look at the whole mutual structure, which kind of the massive offshore expansion exactly at the wrong time. So don't always be negative about South Africa. I think that's the one lesson. The other is there is a difference between the Liberties and the MTNs. The MTNs have a natural position where it says if you're reporting in rands and you have other currencies where you're trading in, when the rand is strong, that will affect your results. Whereas Liberty basically took a view, and they backed that view and they were wrong. So much more sympathy for MTN than for Liberty.